What's behind the instability in global financial markets? Hello, I'm Anand Naidu, and this is The Heat. A renewed bout of volatility hit global markets on Monday. Weak jobs numbers and recent speculation about a U.S. recession contributed to warnings that this year's stock rally may have gone too far. From New York to London and Tokyo, equities were hit hard. Wall Street's fear gauge dropped from about 65 on Monday to about 28 on Wednesday, indicating that investors' fears were easing. But where's it all going? We begin with this report from CGTN's John Terrett.
It began last Wednesday when the Central Bank of the United States, the Federal Reserve, decided to leave interest rates, the Fed funds rate, unchanged for its meeting in July and gave a vague hint that they may cut interest rates in September, but also they may not. The markets on Wednesday rallied strongly on this news, but by Thursday, doubts had crept in because there was concern of a slowdown or even a recession coming in the U.S. economy. Markets were angry that the Federal Reserve had skipped its chance to move interest rates on the Wednesday. By Friday, they had their proof. The July jobs report came in with 114,000 new jobs added and an unemployment rate that ticked up to 4.3%. Not bad, nothing really wrong with that, but the problem is the markets were told to expect much more. Over the weekend, analysts read into the numbers some more and saw real signs of a slowdown or a recession. By Monday, the Nikkei in Tokyo, the 225, had crashed by 12%. Its biggest one-day drop since 1987, and that was Black Monday. And again, it was concerns about worries regarding possible recession in the United States. The contagion spread from Asia into Europe and on to the United States. But it's important to understand there is no real crisis, not like there was in 2008, the global financial crash, or at the end of the dot-com bubble in the early 2000s. This was about rejigging of portfolios, as investors noted that the Bank of Japan hiked interest rates last week, the Bank of England cut them, and the Federal Reserve did nothing at all. Well, the Dow on Monday was down well over 1,000 points. By Tuesday, though, things were looking up. The Bank of Japan was calming the markets, and analysts do warn that the jitters may well yet return. At the height of this, there were calls for the central bank, the Federal Reserve, to have an emergency session and possibly cut interest rates. I think that's unlikely because the Federal Reserve doesn't care about these people here losing money. That's not its brief. It cares about inflation, interest rate, jobs, and the money supply. I think the next time we'll hear from the Fed is Jackson Hole, the international symposium coming up on the 22nd to the 24th of August in Wyoming. And then again, when they're scheduled to meet next September the 18th, they will almost certainly now cut interest rates. The question is by how much? 25 basis points, 50 basis points, and how many more will follow? John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
Well, there is much to talk about. Let's get to our panel. Gong is a professor at the University of International Business and Economics. Remi Piet is co-founder of the international consulting firm Embellie Advisory. Also with us is John Quelch. He's Executive Vice Chancellor at Duke Kunshan University. And Anthony Chan served as Chief Economist for JP Morgan Chase. Thanks, everyone, for being with us. Anthony, we look at stock indices on Monday. They plunged across the world, a $6.4 trillion stock wipeout. But they did stage something of a recovery. They're still in negative territory, but not as bad as they were on Monday. So what's behind the volatility that we're seeing?
Well, Anand, there's a lot of factors out there. Disappointment with the Federal Reserve because they didn't cut rates. The employment report, everybody wanted it to be a lot stronger. 114,000 makes people nervous. But remember, in a recession, it's not a positive 114,000. That number would have a negative sign in it. It did not have a negative sign. And then, of course, the so-called Japanese carry trade, with the central bank in Japan raising interest rates and moving closer to quantitative tightening, that made people worry that they were going to sell assets, stocks in particular in the United States, and bring and unwind those carry trades. So there were a lot of factors. And then when the Bank of Japan sort of said that maybe they're not in a rush to raise interest rates, not in a rush to tighten things out, then maybe there was a little bit less concern about the so-called carry trade. But all in all, we still don't see concrete signs that the economy is going to move into immediate recession, even though the employment report and things like that did not cooperate.
All right, you talked there about a recession, Anthony. You know, the last time we talked, you talked about the SARM rule and what that tells us about the likelihood of a recession. So when you use that rule, where are we now?
Well, we are at the trigger point where a recession is called for. That number in the latest month hit 0.53. The rule of thumb is if that index, which is the 3-month moving average of the unemployment rate, is higher by more than 0.5 percentage point from the low in the last 12 months, that suggests a recession. So are we above 0.5? 0.53. So you really have to go to 2 decimal places to find that. But even the originator of the SARM rule, which is Claudia Sahm, was a New York Federal Reserve president, and said that this time it's a little different. So she's not necessarily holding herself to that rule, because what we've seen, and I've done some research on this, is that much of the reason why the unemployment rate has gone up because labor supply has picked up because of immigration. It's not because people are getting laid off. So a little bit different, and that's why you might want to shade that SARM rule just a tad.
All right, John Quelch, on the question of a recession, I mean, we could look for signs, we could look for indicators on whether there could be a recession. Well, let's look at one. The shipping giant, Maersk, says it's not seeing signs of a recession. In its words, freight demand remains robust, which of course means that the world is trading, countries are trading between each other. So what is your assessment of the uncertainty we're seeing on markets?
If you look at the percentage of world GDP accounted for by international trade, it's actually stronger than it was 10 years ago. International trade has increased rather than adjusted in the face of protectionism and nationalist forces. So I think the trade indicators are very positive, along with, I would say, if I may, Anand, the 2.8% second quarter GDP result in the US. I think that's encouraging. The strength of the service sector in the US is encouraging, and inflation is dipping. So 1 month's odd unemployment or employment statistics, as Anthony implied, I don't think I would draw much of a conclusion from that. But what I do see is perhaps the market getting ahead of its skis in terms of expectancy of interest rate cuts and a natural adjustment to expectations.
Remi Piet, let's look at another view. We had this view from the CEO and the chief strategist for Quelch Intelligence, Danielle Booth. She's also a former advisor to the Federal Reserve Bank of Dallas. And she says that the weakening jobs market and increasing bankruptcy filings indicate the U.S. may already be in a, quote, plain vanilla recession. What do you make of that?
Well, I believe it's slightly exaggerated, because we're looking in terms of even the performance on the stock market. We've seen some very strong performance over 3 to 6 months. Indeed, is there like a decrease in the speed and the growth of the American economy? Potentially is very much linked to the decision from the Fed Bank not to decrease its rate, and that's probably something that will happen in September. I agree that we'll have to wait for a couple of months. But when you look at the fundamentals of the American economy, it's actually quite satisfying and stable. You have a rise of unemployment, but still fairly a number which is reasonable at 4.3%. You have inflation that could actually decrease stronger. But in terms of investment, so the capacity of the American economy to rebound, I think we're still seeing some very favorable side on the side of the American economy. The European markets have also kind of buffered the impact of the crisis. Obviously starting in Tokyo and then coming to the market in the US because of lack of potential saving and more volatile markets. But when you arrive to more mature market on the European Union, you've seen kind of a decrease of the potential crisis effect and rebound that started from there.
John Gong, expectations of a U.S. interest rate cut in September, that drove China's yuan, the currency, to a 7-month high against the dollar on Monday. So how does the stock market turbulence impact China's economy?
Well, let me first say a few words about the stock market. I think there are a combination of reasons. Certainly, I would point to the fact that the stock in the United States has been experiencing a fairly impressive run-up for the last couple of months, and it's quite natural to expect some level of technical correction. You know, the traders and investors would like to take the money off the table, and coupled with the a little bit negative news on the unemployment side, you see this drop in Dow Jones. To be honest with you, I want to concur with all the three previous speakers that I am not so convinced that the U.S. is entering into a recession. I mean, we as economists, we know about the technical definition of recession. That means that GDP has to be seeing a negative growth. I just don't see that. I've been traveling in the last 2 weeks on the East Coast of the United States. I've been going to a couple of shopping malls and go to restaurants. I see these places are pretty full and crowded and packed with people. Consumers are spending. So I really, from a casual observation, I don't see that's happening. Back to your question about Chinese yuan's appreciation. I think we have to keep in mind that the yuan has been experiencing a devaluation for a very long time. I remember it has depreciated from 6.5 something, less than 6.5, all the way to close to 7.3. That's a very significant depreciation. And now I start to see that the tide may be turning in a very significant way as the rate in the United States is starting to decline. So I think we are probably seeing the very beginning of a fairly prolonged trend of yuan's strengthening, in my view. So I think this is really the tipping point at this time. And I would expect that aided with the very encouraging news on the export sector, on the trade surplus dimension, I would expect that the yuan would further appreciate for a little bit more, maybe breaking the 7-point mark, in my view.
Right, on that point, John Gong, on the currency, the Central Bank of China, they have something called a fixing, don't they, where they fix the price and it can't go 2% on either, beyond 2% on either side, right?
Well, I mean, the central bank's rule is it doesn't want to see a very rapid, precipitous change in either direction, actually. So what they have been imposed is a daily trading band restriction. In other words, the fluctuation cannot be more than 2% on both sides. Yeah. Otherwise, it will trigger essentially a halt of the market. Mm-hmm. So, essentially what the central bank is doing is to essentially encourage a sort of a measured, controlled a change of direction in either direction, actually. That's the way it is. But I think this is not going to, a technical rule is not going to change or stop the overall market, the currency market change in its trend, its direction. This rule is just technical. It may slow down things. But ultimately, I think the yuan's direction is starting to change now.
Right, great point. Anthony, we've been talking for some time now about the likelihood of a rate cut coming in September, but some analysts are talking about what they're calling an emergency interest rate cut before September. And here's the Federal Reserve Chairman, Jerome Powell. He testified in Congress on the factors that determine the timing of an interest rate cut. Let's listen to him.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
So Anthony, as you've pointed out before, interest rates are very high. So that does give the Federal Reserve plenty of room to maneuver, doesn't it? How do you see it?
Absolutely, and the Fed doesn't want to rock the boat. I was a former Federal Reserve economist at the New York Fed and also worked at the Board of Governors during the Paul Volcker era. And guess what? They never want to destabilize the markets. And right now, for them to do an emergency meeting because the equity market dropped a little bit. Remember, last year in October, the equity market dropped by 10%. Nobody was talking about emergency meetings. And guess what? Every year the market moves and has 10% correction. So this is not a huge move in the context of history, nor is it in the context of what normally happens in financial markets. So I think an emergency meeting before their September meeting is off the table. I think that they will move in September. And I think that between now and then, we're going to get some inflation numbers. And inflation, if you look at their favorite inflation number, the price consumption deflator, headline number, running at around 2.5% year over year. It's close enough to the target that if we see a further weakening in inflation, and we see further weakening in, say, the next employment report, then I think that the Federal Reserve can move 50 basis points, but no need to move intermeeting. They will do it in a calm fashion. It will be 25 or 50 basis points, depending on what the inflation numbers and the next employment report tells us. But I suspect that the next employment report will be a lot stronger than the one we just had.
Right, John Quelch, another factor we want to look at is the role of artificial intelligence. I mean, it is a key tool for companies looking to cut costs. Employers are still looking at how to fit this new technology into their business models. How will AI impact the job market? I mean, some analysts have called it a weapon of mass destruction. How do you see it?
Certainly, AI has the potential to dislocate current employment patterns, but at the same time as improving productivity, there's also the opportunity for new jobs to open up. So I think most commentators in this area, like myself, see a balance here. Some losers, but many, many winners as well. Obviously, the market hit in the last week has been particularly targeting the AI-based stocks on the NASDAQ that perhaps have been overinflated in valuation as a result of enthusiasm around AI quickly taking over the world. Usually when these innovations come along, they are much slower to permeate than most people who are enthusiastic about them believe is going to be the case. But there is, at some point, a tipping point where after a relatively slow adoption, all of a sudden there's a run to the door and the lemmings all follow, and there's a flood of new AI activity that's likely to occur. When that tipping point actually occurs, I can't tell you, but certainly what we're seeing at the moment is probably a correction against an over-optimism about AI taking over too much too quickly.
John Gong, I just want to pick up on that point that John Quelch made, and that, you know, on the overvaluation of stocks. I mean, some analysts believe that tech stocks are overvalued, and that you know, companies are AI companies are yet to see the benefits they've made in artificial intelligence. What are your thoughts on that? John Gong? Can you hear me, John? No, okay. All right, let me put that question to Remi. Remi Piet, what are your thoughts on the fact that, you know, tech stocks could be overvalued and companies are still waiting to see the benefits of this technology?
When you talk about AI, you're looking at a lot of systemic changes in terms of production chains, in terms of value creation, something quite similar to what we've seen in terms of the arrival of internet, if I want to make kind of a link. And obviously at moments when you have uncertainty on the market, these are the most volatile and the most, risky values that are impacted. So you know, new technologies that still need to become mature. The cryptocurrency obviously took a serious hit. I mean, obviously it's a very different market, and AI definitely has a strong future to in the upcoming month. What we've seen is maybe a return indeed to some more stable and more risk-averse positioning in terms of investment in markets that are more mature, and the fact that the Japanese economy or the American economy, which has a limitation in terms of saving and sometimes equity heavily backing some of those investments, especially in the high-tech sector, obviously took a strongest hit than other sectors of the economy.
Right, okay, John Gong is back with us. John, I want to get your thoughts on that. I was talking about tech stocks being overvalued before we lost you there. I mean, you did say a moment ago that you thought what's going on in the markets right now is a technical correction, but what about this, this theory that tech stocks are overvalued?
Well, I mean, in history, things are like that happen all the time. I remember in the late 1990s, there was the telecom bubble. Remember these fiber optic stocks, shooting through the roof? And then you have the dot-com bubble, and then you have these internet stocks. Now it's these AI stocks. I think, history tends to repeat itself, especially in the equity market. I would expect to see the market exuberance with respect to these AI stocks will reckon with reality sometime. And it seems to me that that's the moment right now, at least for the short run. I think ultimately it's not these concepts that actually determine the fundamental value of stocks, but it's really the dividends, it's really the earnings driving the stock performance. I think people can tell these stories about these companies, but ultimately I think we have to see the bottom line, what's going to happen. And I would suspect that at this level, I mean, look at the stock prices of these AI stocks like NVIDIA, like some chip companies. They are very, very expensive. So I would expect that market correction, technical correction, is bound to happen. And maybe maybe not just one round, maybe more rounds would follow. But in any case, I think it's a healthy thing. Otherwise, these stocks will keep running up, and ultimately it's going to have to see a big crash. I think I would rather see some technical corrections on and off right now, as opposed to a big crash down the road. That's just too terrifying to see.
Anthony, at the beginning of the show, you were talking about this investment strategy known as carry trade. In fact, the Associated Press reports that the market mayhem this week was partly caused by this strategy called carry trade. What exactly is it, and how would it contribute to this kind of turbulence that we're talking about?
Well, Anand, what you have is a situation where in Japan, they had very low interest rates for a couple of decades, more than a decade. And so what these hedge funds will do is go ahead and borrow money in Japan, and they take that money and then they invest it in other countries where the rates of return are higher, the interest rates are higher. And of course, the United States, compared to Japan, had very, very high rates. So they can invest in treasury bills, treasury bonds, they can invest in the equity markets, they can invest in the Nvidias of the world, the Microsofts of the world. But when all of a sudden it looks like the Japanese are going to be starting to raise interest rates, and it looks like all of a sudden they're going to be more restrictive, then that beneficial advantage that you get from borrowing at very low interest rates as those rates come up becomes less so. And so there's a panic, and you have to close those carry trades. So you start selling the assets, whether it be treasury bonds, whether it be the Nvidias of the world or other equity markets. And so you see that decline out there. Even Bitcoin, the assumption was that you were using some of those loans to buy Bitcoin. And of course, all those risk-on assets started to go down. But when the Bank of Japan sort of said, we're not going to do it in a rush, we're sort of going to look at things and maybe not be so hasty, then it basically gave an opportunity to re-enter that carry trade, or at least not get out of it so quickly. But that certainly was one of the catalysts, but it was just one of those catalysts. There were many other catalysts for the equity market sell-off.
John Quelch, as we said at the beginning, we saw stocks plunge on Monday, then they recovered somewhat. They made up some of the lost ground on Tuesday, fell again on Wednesday. For ordinary investors, even passive investors, people who have 401k accounts, putting money away for their retirement and things like that. I mean, what changed in that period? I mean, what do ordinary people look for when they look at their investment accounts?
Well, and I think there's a minority of people who do track these accounts on a daily basis.
Right.
And typically are then tempted into making adjustments in their portfolio that may actually be detrimental to them in the long run. Probably for the ordinary investor, the ordinary consumer and 401k consumer, it's not sensible to follow the market every day. Occasionally, there will be very, very significant corrections, as in 1987 and following the dot-com bubble. But for the most part, stocks always outperform bonds, and bonds usually outperform cash over the long term. So when you look at the current state of the markets and compare last year's data for exactly the same date, August 2023, we are double digits up on most of the major indices. And that's, I think, healthy and positive for the ordinary 401k investor.
Remi Piet, to what extent does political, I wouldn't say instability, but uncertainty play into the kind of volatility we see on stock markets? I'm thinking particularly of the upcoming United States election. At this stage, it's neck and neck. We really can't tell with any kind of certainty who's going to emerge victorious.
Well, I'm not sure it has a direct impact in terms of right now. I mean, especially with the change of candidate on the Democratic ticket, and we're still looking at an election that we're still quite a few months and 92 days, if I'm not wrong, to go. I completely agree with my colleagues of the technicalities and the fact that the correction of the market is really triggered by a series of news of different positions from federal banks. Japanese increased their rates while the American stayed stable and the British decreased it. So as a result, that really led to a relocation of investment that may suffer the Japanese economy and some of the most exposed American stocks. The political climate does have an impact in terms of looking at decision, in terms of societal decision, right, and cohesion decision. And in terms of economics, we've seen quite a synergy between Democrats Party and the Republican Party on fighting inflation and tax reform. So I'm not sure it has such an impact.
Right, John Gong, I've just got about a minute left, and I do want to address one other thing. You know, we were talking earlier on about the yuan surging. What happens if there is a sustained appreciation of the currency?
Well, I think the central bank in China, the People's Bank of China, has a limit, I think. It doesn't want to see yuan to appreciate too much because ultimately it's going to hurt China's exports. I would imagine, maybe at most 6.5 would be probably the limits that the central bank can accommodate and can accept. Otherwise, it's going to be problematic for the export sector. You have to understand that currently, China's economy is still experiencing some difficulties, and the export sector remains one of the few bright spots. And I don't think we want to see that bright spot to be spoiled by the currency issue. I do want to add a note on the presidential election. I think what the Fed does, it usually wants to stay out of politics. I don't think it has any preference for Democrats.
Okay, I'm sure we'll have an opportunity to talk much more about that in the coming weeks. John, thanks a lot. Thanks to all of you for being with us. That's it for this edition of The Heat. I'm Anand Naidu in Washington, D.C.